Right, so this is actually a duplex. So going back to your question, as you see, it looks a little bit like the picture we showed you on the asset type, a single building with 2 units here. And this is how we analyze deals and put together for our clients. So you typically get these sheets, and on the top row is the summary of and we'll go into the analysis in a minute, but it's a summary of what the asset produces. So you see here, this asset has a cash-on-cash return on investment of just shy of 7%. The investor here in this case is putting nearly 100,000, and he's getting a steady income here of 575 on a monthly basis. And you see here again, this cap rate comes up. This is what the asset produces. So the operating income of the asset divided by its price. And then it spells out here the assumptions that we've put in this sheet. So you can see the purchase price, you can see the down payment the investor put, his interest rate at the time. And this is actually a real case scenario only a couple months ago. So this is very fresh numbers from what we're seeing in the market right now. And in expenses here, you can see the different allocations. Some are hard expenses, such as property taxes, HOA fees, and then some are more provisions, like we've provisioned here for maintenance. We've provisioned for a certain vacancy of this asset. So we'll put in non-cash expenses so that your projected cash-on-cash return and your projected cap rate is more accurate, and you know where you stand on things. Now, the last metric we talked about, that's very important. It actually goes on page 2. It's your annualized total return. So that's this line here, annualized total return. And you see it's broken out obviously by year because it assumes you're going to sell the asset. So if you sell the asset year 5, which is typically what investors do, they hold assets for a period of 5 years, and then they decide if they should sell the asset and roll it into something bigger, or maybe refi the asset to keep the leverage up. But in this case, you'll see the annualized total return year 5 is 18%, and it gives you a projection. So you'll see that as time goes on and your leverage goes down because he's buying down the loan, that tends to go back to the cap rate. So that's, if you own the asset cash, that's what your investment is, cap rate.
We have a question in the chat.
Sure.
It's better to invest in short-term or long-term rentals properties for this type of deals, a duplex or single families? And yeah, what are the most crucial difference for a new investor?
Yes, I think that's a great question. Short-term rentals have been very popular with COVID. A lot of people working remotely, wanting to spend a few months in Houston. They will go ahead and do a short-term rental. So the numbers that we're seeing at the moment for short-term rentals, you do get a higher, on a monthly basis, a higher rental rate than if you rent on a year basis. You've got more variability in your cash flows, of course, because you're turning over tenants more often, and you've also got so more variability in that cash flow, and then also more work typically. I mean, you have to move in, move out people. Unless you can sort of short-term rental for a few months at a time, you can sort of go to the Airbnb model where that's actually a lot of work. So it depends how much work you're willing to put. These numbers here, they're based on a long-term 1-year lease. So these assets here, if we go back up, they both rent at $1,500 each, creating a monthly income of $3,000.